Let's talk mortgage mathematics. Now, if you own a home or you are thinking about buying a home, then you know that it's an extremely huge financial decision. There is a lot of costs and rates that really determine your profitability in this financial decision. I'm sure you've all been on websites like Zillow or Redfin. These are websites that you go to when you want to buy a home. And you'll see all the different homes and the different prices for these homes. And usually Zillow will provide you an estimate of your monthly payment. So how is this calculated? Well, that's what I'm going to explain to you in this video. So let's turn over to my Excel spreadsheet over here. Just to give you a quick overview of this spreadsheet, there are three sections in this spreadsheet. There's a section for purchasing the home, a section for selling the home, and an investment section that focuses on what would happen if you invested the money that you would have used to buy the home in something else, right? And then we have a legend that explains some of the highlighted fields and what they mean. Now let's look at a real world example. That house we were just looking at in Atlanta, Georgia is $449,900. That is your purchase price. But that is not how much your loan amount will be. Your loan amount will be the purchase price minus the down payment. So in this case, my down payment is a 20% down payment, which will be 89,000. But let's say I wanted to do a 10%, right? That means I'll be doing $44,000 down, right? My interest, 3.3%. You talk to your broker, they'll tell you what interest you'll get. Depends on your credit. And with these numbers, we're able to calculate the principal and interest, monthly principal and interest for the loan. The formula for doing that is right here. You can find it all over the internet. I don't want to focus on that. So your monthly principal and interest is what you pay every month for 30 years. And that's 360 monthly payments for a 30-year loan or 180 monthly payments for a 15-year loan. Your monthly payment will also include some other fees like your home insurance premiums, your property tax, your homeowners association fees, and that will increase your monthly mortgage to around 2,478. All these numbers here are estimates, but if I find out the actual, I could just type it in. Like if tomorrow I find out that the homeowner's insurance for this property I'm looking at is 2,000 per year, I'll just type it in right here, right? If I find out that the PMI that I'm going to get yearly would be 5,000, I'll just type it in, right? And as you can see, the monthly mortgage number changes as I change the number, right? The estimates are good enough for me because it's really about understanding the math behind it, right? You get your purchase price, your down payment, your interest rate, and the term, and you'll be able to calculate your principal and interest monthly payments. You add in the monthly fees associated with it, then you get your monthly mortgage. Let's look at the mortgage schedule tab to actually see the mechanics behind this monthly payments. You start off at the beginning with a loan amount of $404,000. And then every month after that, you pay a little bit off, and the loan in a process called amortization, where you're paying off the loan little by little every month until you get to 30 years later and you've paid off everything and you owe nothing and you're done. Now, this column G is a column I added that shows you how much you would have actually paid at the end of the loan. Because remember, you're not just paying off the loan, you're also paying interest and you're also paying fees like insurance and property taxes, right? So, really, after 30 years, if all things remain the same, all things being equal, you would have actually paid $892,000 to own a $449,000 home. And if I want to ignore the cost like HOA fees and insurance, and I just want to focus on principal and interest, well, at the end of 30 years, you would have spent $634,000 on the home, on just principal and interest, right? So for a home that was worth 449,000, you would have paid $639,000, and that's because of all the interest you pay, right? You would have paid $229,000 in interest. One more thing I want to point out here is look at the balance amount. It reduces by the principal, right? Not by the principal and interest. So what do I mean? I mean you have a loan of 404,910. Then by the next month, you have a loan, your loan amount that's remaining is 404,244. That's because we subtracted the principal from that amount, not the principal and the interest. So the principal goes towards the loan. The interest is just a fee you give to the bank, right? We already showed you how to calculate the principal and interest, right? And so you'll notice that at the early stages of the loan, the interest is higher than the principal. The bank gets all their money back first. Towards the end of the loan, the interest is almost all paid off, and now it's really just mostly principal, right? That's just how the math works. The amortization math, that's how it works. Now, a lot of people buy homes because of the tax breaks, right? So what this is basically telling me is that the longer you stay in the home, the less benefits I'll get from taxes because you can deduct your interest payments in your itemized deductions and taxes. And I say all this just to show you that I include that value in this sheet, max interest deduction, so that when you're thinking about buying a home, you could also think about the interest impact and know if you'll be able to get any tax benefits from it. So now let's look at the cool stuff. When you buy a home, at least the way I think about it is, what is the profitability? Why do people always say you always make money when you buy a home? The best decision you could ever make is buying a home. Well, let's look at the numbers. Let's say you bought a home for 449,900. Let's say now, 1 year later, the house is worth 450,000. So it didn't really go anywhere. So 1 year later, that will be 12 months. If I sell the house 1 year later for 450,000, I'll make $53,000, right? That's not really profit because, hey, I had a down payment. I had a purchase price of 58,000, which was the down payment plus the closing costs. The longer I stay in the house, let's say I stayed for 48 months. See, the price didn't even go up, but look, my profit went up. That's the benefit of buying versus renting. Even though the price didn't go up, my profit went up because as I pay mortgage payments, I'm paying off the house. Let's go back to the mortgage schedule so you understand. If I sold a house on the first month, let's say I sold it for 450,000, then my profit would be 450 minus 400,000. That's the first month. Let's say I sold it at the 18th month. Now it's 450,000 minus 392,000. So that's more profit for me. So even though the price didn't really go up, just the mere fact that I'm paying towards the house, that is a benefit that you'll get from owning a house over renting any day. But there are some disadvantages to buying over renting, and I just wanted to use this sheet to highlight. I have a rental savings tab here. Let's say my rent was 1,800, and now my mortgage is 2,478. So that means in 48-month period, there's a $32,000 amount that I did not save because I made a decision to purchase. That's what this number here is. This first number tells you, hey, if I sold the house, how much would I get? Right? This number says, what is my profit if I factor in that I already spent money to buy it, so my purchase amount, the amount that went out when I bought it, and the amount I've lost from the higher rental or the amount I've made from the lower mortgage, right? So in this case, I really haven't made any money on this purchase. Yes, if I sold it 4 years later and I got 79,000, I'll think to myself, woohoo, 79,000. But if you really look at all the costs, you have not made money. You have lost money, right? If you had taken that same $58,000 you used to buy it, invested it in a money making instrument that, like a mutual fund or something that earned 10%, you would have made $23,000, right? Now, of course, the chances of the house staying at $450,000 are rare. If it just goes up by a little bit, if it just went up to 480,000, there you go. You've made money. It's a great decision. It beats the investment anytime, right? So this shows you why, renting is usually not the best decision over buying. But what if you were renting for 1,200? What if your rent was 1,200 and now you've gone up to 24, gone up to a mortgage of 2,478? Well, once again, maybe that wasn't the best decision to switch to mortgage. Because yes, even though the price of the home went up and all that, but you're paying so much more in mortgage now than you were paying in rent that in a 4 year period you really haven't made money, really, right? Because the mortgage is so much more than the rent. I'd have to stay in here longer or wait till the price rises higher for it to be worth it. Maybe it goes up to 500,000. Now it's worth it. Well, what if it went down instead of going up to 500? Maybe what if it went down to 400,000? Now I'm really in the red, right? So that's really all I have to talk to you guys about today. I just wanted to let you know that there's a lot of things that go into this thought process, right? It's not just if the price goes up. The price could go down, but also you have to take into account that there's money you paid to buy the house. So even if you sell the house and you see some money coming in, you have to subtract it from the money you paid to buy. And you also have to subtract it from the rental savings or losses that you have from going to a higher or a lower mortgage. Now, if my rent was substantially higher than my mortgage, let's say if my rent was 3,000, let me say 3,500, and I went to 2,500. Then you can see going from a high rent to a low mortgage, I was able to. It was still a good decision, even though the price went down. So even though the price of the house went down, it's still a better decision for me. I still made money by going to buy and staying in that house for 4 years. So I hope this helps. Thanks for watching. If you have any questions, please leave them in the comments below. My name is Emeka. See you next time.